Hey guys, welcome back to Clownfish TV. This is Neon and we're going to talk about Netflix. Yeah, we're going to talk doom and gloom. Doom and gloom, everyone. Doom and gloom from Forbes regarding Netflix and kind of where they're at right now in light of all the major announcements at D23 about all the Disney Plus content coming out. Again, most of the shows coming to Disney Plus we already knew about, but now we're actually starting to see some footage. They did announce some other Marvel shows. It's basically Marvel and Star Wars. And yeah, so anyway, Disney Plus is right around the corner. Netflix is not doing so hot compared to where they were a year ago. They're not the only player in town. You know, there were record losses in subscribers and in valuation. I think they lost like $17 billion in valuation like a single day. There are multiple news outlets out there telling people to dump their Netflix stock or at least don't buy any more of it. I actually have some, so I don't know what I'm going to do with it next, but we will see what happens. Now Forbes is out there telling people that Netflix is doomed. Netflix is doomed, coming from Forbes. So here we go. All the reasons why Netflix is doomed. Stock is down 15% after the company missed subscriber expectations for Q2, and short interest is up 20% over the last month. Yeah, we did a video the other day talking about how they chopped their animation division. We don't know what's going on over there. It seems like there are a lot of animated series that are kind of up in the air because, you know, animated series are expensive. They're expensive, and you know, maybe Netflix isn't prepared to spend what it costs to you know, push forward on some of these animated projects. Maybe it's cheaper just to bring anime over and dub it. I don't know. We're going to do another video talking about that later. Hopefully later this weekend, later today, talking about where anime is and the big picture of the animation industry, since we do talk about that on this channel quite a bit. So at this point, I think, again, this is coming from David Trainer from Forbes, it's hard to ignore all the red flags in Netflix's fundamentals and valuation. Here's a list of all the reasons why Netflix will struggle to justify its valuation. Netflix is in the danger zone. Netflix is in the danger zone, coming from Forbes. Content spending not adding enough subscribers. This is true. There was a joke for years, and we've talked about that before, that Netflix would basically greenlight anything, but not all of the shows that they're greenlighting are actually bringing subscribers to the service. They're not retaining people. We're seeing shows get chopped after 2 or 3 seasons, even if they were moderately popular. So I don't know. All right, Netflix's biggest problem is paying more and more to acquire new subscribers. Marketing and streaming content spending has risen from $308 per new subscriber to $581 per new subscriber. Everybody knows what Netflix is now. If they're not subscribed to Netflix, you don't need to market to them. Maybe market the shows better. I don't know. Meanwhile, revenue and subscriber growth is slowing. As they showed in Netflix's original content strategy is failing. Wow, he did another article about doom and gloom at Netflix. The company's incremental expenditures each year about 50% higher than its incremental revenue. Rising customer acquisition costs make it hard to see how the company reverses its trend of negative free cash flow, still reliant on licensed content, which it is losing. This is a big one. Netflix does not own a lot of its own original content, even, or exclusive content. Despite Netflix's heavy spending on original content, shows and movies licensed from third-party studios continue to drive the majority of the company's viewing hours. Netflix does not release its own viewing data. That's a big thing. Netflix does not make its numbers public, so you have no idea how many hours or how many, quote-unquote, downloads these videos are getting. But the numbers from analytics company 7Park Data suggest that as of last fall, licensed content accounted for 63% of viewing hours on the platform. So more than half of the watch time on Netflix is coming from stuff that Netflix doesn't own. And a lot of it are big shows that have been confirmed to be leaving. You know, major sitcoms, they're going to other platforms. The same data showed us that The Office and Friends are 2 of the top 3 streamed shows on Netflix. I wrote about this in Loss of Licensed Content is an underrated crisis for Netflix. He must be like the Netflix guy at Forbes. Netflix doesn't appear to have a plan in place to replace these beloved shows when they depart the service in 2020 and 2021. Benioff and Weiss deal reeks of desperation. D&D reeks of desperation. They threw a ridiculous amount of money at the Game of Thrones guys to get them on the platform. And Forbes is saying they're desperate to do that. Netflix's latest strategy is to spend big bucks and burn more cash to sign up big name writers and producers to create original content for the platform. And it's risky. Most recently, the company signed up Game of Thrones showrunners Benioff and Weiss to a reported $200 million deal, almost $250 million for two guys. Speaking to CNBC, New Construct CEO David Traynor said this deal reeks of desperation. Reeks of desperation. Looking at the facts, it's hard to see how the Benioff and Weiss deal can generate value for Netflix. The screenwriting pair have little goodwill from oh wow. The screenwriting pair have little goodwill from fans after the final season of Game of Thrones, and they don't exactly have a huge track record of hits outside of the HBO adaptation of Game of Thrones. It wasn't even their stuff. Plus, they've already signed on to produce a new Star Wars trilogy for Disney. I bet that's going to change, or at least the deal is going to be altered somewhat. So it's unclear how much time they'll have to devote to Netflix shows in the future. Netflix appears to be falling victim to the overvaluation trap and feels the need to swing for the fences in order to attempt to justify its inflated valuation. Yeah, Netflix is way overpriced. Their stock is way overpriced. I think it's like, what, $350, $400 a share not too long ago? I don't know. It's crazy. While these high-profile, fashionable deals may get some headlines, we think they will destroy shareholder value over the long term. So pricing power evaporating. Pricing power has long been one of the major bull cases for the stock. By this argument, the company is keeping its price low now to attract new customers, but the service is sticky enough that they'll be able to raise prices in the future. They're already doing that. Netflix, I think it started at like $7 or $8 a month, and now it's up to like $15 a month. This bull case doesn't stand up to scrutiny. Streaming services actually face relatively high churn, with 18% of streaming subscribers dropping their service each year. After its recent price increase, Netflix actually saw U.S. subscriber base saw a decline in the most recent quarter. As I wrote in my other Netflix article of like 900 different Netflix articles they put on Forbes. As I wrote my article, reality is closing in on Netflix. The company's price increases are not the result of pricing power, but instead a reaction to its rising content costs. Competition's ramping up. This is what we're talking about. This is what we've been talking about. Netflix is going to have competition from Amazon Prime, which has sort of been dipping a toe into original content. They haven't really gone all in, but they are producing more and more stuff. HBO Now, which is Warner Media's streaming service, which is coming out next year, and Hulu, which is part of Disney. Disney Plus, of course, making a ton of announcements at D23 this weekend. NBC Universal are supposed to be launching their own streaming service too, and I think this is wrong. Time Warner and HBO. I think these are the same thing, dude. NBC Universal is for sure though going to launch its own streaming service, and I wouldn't be surprised if Viacom with the Viacom CBS thing, if they were doing something with CBS All Access or rebranded it or something. So yeah, there's going to be like 5 or 6 streaming services, and as a consumer, are you going to subscribe to all of them? Because then you're talking it's your cable bill all over again, except more expensive. Or are you just going to pick and choose a couple that you like? Disney's streaming efforts in particular represent a significant threat to Netflix. Disney CEO Bob Iger announced on the company's recent earnings call that it will offer a bundle of Disney Plus, ESPN Plus, which wasn't doing that great, and ad-supported Hulu for $12.99 a month. The same price as Netflix is in the US. I wrote in Disney's Avengers spell Endgame for Netflix. God, these titles are so dire. I can't say anything, but these titles are so like, Netflix is gonna die. They're gonna die. Disney's wildly popular tentpole franchises give it a significant edge in the streaming wars, and its ability to bundle that content with live sports and popular third-party shows is a major competitive advantage. Netflix is more like traditional TV network now. Yeah, it's true. It's true. The combination of all the above points, increased competition, lack of pricing power, and loss of content leads to a simple conclusion. Netflix is no longer a revolutionary tech platform. It's just another TV network. That's true. Netflix became the very thing it rallied against at the beginning. So I've been making this argument since 2016. Again, another doom and gloom article. The spell is broken. Netflix is more like a traditional TV network. However, Netflix's valuation does not resemble a TV network. The company had an enterprise value of $150 billion, about 5 times the value of the largest standalone TV network we cover, CBS. Some people might scoff at the comparison of these two companies, but they earned about the same amount of revenue last year, $15 billion. CBS generated $1.7 in free cash flow to Netflix's negative $4.5 billion. Reliance on credit creates risk. Yeah, so they are relying heavily on credit. The company raised $2 billion in debt earlier this year, bringing its total debt burden to $14 billion. Netflix is in debt, $14 billion. Given the company's projections for continued negative cash flow, free cash flow, we should expect even more debt raises on the horizon. They said that Wall Street is basically pushing people to buy Netflix. Netflix can't sustain the cycle of debt-fueled growth forever. And the valuation remains unrealistic. This is interesting too, because they said eventually it's going to run out of momentum. Hey, actually he did an article called Netflix's Momentum Has Run Out. Another happy bedtime stories. In many other articles, it's hard to create a plausible future cash flow scenario where Netflix justifies its valuation. Now they're talking about, they said that Netflix would have to grow its subscribers by 30 million annually, and roughly its rate of growth in 2018. That's not going to happen. It might happen outside the U.S., but they said that the takeaway here is, could there be an acquisition bailout on the horizon? Could somebody come in and buy Netflix? And they said it's not realistic right now. They said the only real remaining candidate would be Apple, because everybody else has their own streaming service now. And they said it seems very unlikely because Apple's largest acquisition was Beats. They bought Beats Electronics for $3 billion, which is 1/50th the price of Netflix. Unless Netflix's stock declines by a massive amount, it seems pretty clear there's no white knight willing to bail out Netflix investors and buy the company at anywhere near its current valuation. So this is not a good look for Netflix to have Forbes. Actually, Forbes is really taking a lot of shots at Netflix. They said that Netflix is it's overinflated and it's going to look long in the tooth when these other streaming services come out. Now, it'll be interesting to see if Disney and Universal and Warner can all hit the ground running like Netflix did. And people care, because I know a lot of other companies have tried to start their own streaming services and they just never really took off. But if all the content's leaving, what are they going to do? So we're going to watch Netflix. Interestingly enough, The Motley Fool put out kind of a counterpoint that Netflix is going to be okay in the long run. Will they make it? I don't know. Because everybody's talking doom and gloom for Netflix stock. So we'll see. I mean, personally, with Disney Plus, I see it as kind of a threat. I'm looking at the initial launch, and I'm not really wowed. I mean, yeah, there's Star Wars content. There's eventually going to be Marvel content, but we're talking to get this full slate of content that they've been teasing. It's still going to take a couple of years for Disney to catch up. So I don't know. But look for more cutbacks at Netflix, I think. They need to be ramping up the spending on, their own content, but they also need to spend wisely. And, the days of them greenlighting anything are definitely going to come to an end, especially with them cutting a $200 million check to Benioff and Weiss. They might, depending on how that goes, they might have been better off just, lighting that money on fire. Who knows? Who knows what's going to happen? So we'll keep an eye on Netflix here on Clownfish TV. It does dovetail with all the other stuff that we talk about, considering we talk about pop culture, we talk about animation. Netflix is sort of one of the major homes for animation right now. So we like to keep an eye on it and see where things are at, because if Netflix does poorly, then, we're probably going to see less original animation. That's not good. We like animation, right? Everybody likes animation. So please subscribe for more pop culture news, views, and rants here on Clownfish TV. This has been Neon, and we will talk later. Hey guys, thanks for watching Clownfish TV. Please consider supporting the channel. Go to clownfishsupport.com. That's clownfishsupport.com. And if you want to join our community, go to clownfishtalk.com. That's clownfishtalk.com. Please subscribe. Ring the bell for notifications. We will talk to you next time.